So is a quantitative tool which is used to show the lump sum value of the proceeds received in a particular period. So here we say that the terminal value equal to A into 1 plus R to the power n. So A is the amount invested. A is the amount invested. R is the rate of interest. N is a period for which it is invested. So if it is a compounded in times per annum, here if I say it is 1 year, n means 1. If it is 2 year, it is 2. If it is compounded in a years for many time, then the formula will be terminal value equal to amount invested 1 plus rate of interest divided by m. M is a period of compounding. If in a year it is 2 times, you can make it say that it is compounded for 2 times to the power mn. So let us take the amount invested as 100. The rate of interest is 10% and number of years is 1. If it is compounded once for a year, the formula we can use this formula. So 100 is it audible now? Okay. Okay, 100. So this is the formula for calculating the terminal value. So a plus 1 plus r to the power n. If it is not compounded. So n means number of years, r means rate of interest, a means the amount invested. If it is compounded many times in a year, then we will be using this formula, a into 1 plus r divided by m. M here stands for the number of times it is compounded to the power of mn. So let us suppose the amount is 100, rate of interest is 10%, and number of years is 1. So it will be like 1 plus 0.10 to the power 1. So you will get 110. The amount which is invested in a year, the rate of interest will be 10%, and the terminal value will be 110 in a year. So if it is compounded twice in a year, we will be using the formula like this. Hundred to 1 plus 10%, it's already 0.1 0.10. Again, when you divide it by 0.10, the rate is 0.10 divided by m. M is 2 times. If it is compounded 2 times in a year, so we assume that m is 2 times in a year, then 0.10 divided by 2 to the power M into N. So M stands for the number of times it is compounded into rate of interest 1. So this will be 100 plus 1.05, 2 into 1, 2 times. So you will get 110.25. If it is compounded twice in a year, the terminal value of the amount which is being invested, it will be 110.25. This is, we call it as compounding. Then another term which is called as short selling. This refers to the selling of securities which are not owned by the investor at the time of sale. It is also called as shorting with the intention of buying later. Short selling may not be possible for all investment assets. It yields a profit to the investor when the price of the asset goes down and loss when it goes up. So let us take an example. An investor might contact his broker to short 500 shares of a company. Then the broker will borrow the shares from another client and sell them in the open market. So the investor can maintain the short position provided. So there are shares available. There should be the shares which should be available for the brokers to borrow. Otherwise, it is not possible for short selling. So valuation of forward contract. So this valuation is on the basis of certain assumptions and notations that there is no transaction cost. Same rate is applicable for all the trading profits, borrowing and lending of money at the risk-free interest rate. Traders are equally available for all the market participants, large or small. The forward price for investing assets securities. Here we will consider three situations in case of investment assets. So the first one, investment assets provide no income. Second one, investment assets providing a known income. Third one, investment assets providing a known dividend. So first let us start with investment assets which are providing no income. So this is the easiest forward contract. This one, the investment asset which is not providing any income, is the easiest forward contract. This is the easiest forward contract to value because such assets do not give any income to the holder. So these are usually non-dividend payout equity shares and dividend bonds, which do not provide any income to the investors. So let us consider the relationship between the forward price and spot price. Consider a long forward contract to purchase a shares in 3 months. So current stock price is 100. Current stock price is 100. 3 months risk-free interest rate is 6% per annum. So let us assume that after 3 months the forward price is 105. So spot price is 100. By keeping a forward contract, long forward contract to purchase a share in 3 months, for which the spot price is 100. After 3 months, we assume that the forward price is going to be 105. So we are going to borrow 100 at the rate of 6% for 3 months, buy one shares at rupees 100 and a short a forward contract for 105. So we are going to borrow rupees 100. So we are going to borrow $100 or whatever. You are going to borrow 100 for the rate of 6% for 3 months, and you are going to keep it. You are going to be in a short position, and you are going to short a forward contract for which the forward price is 105. So at the end of 3 months, the you are going to deliver the shares for 105. You are going to deliver the shares for 105, and the sum of money which is required by you to pay the money which you borrowed is calculated like this. We have borrowed 100 rupees, and the rate of interest for which is 6%. We have borrowed 100 rupees. The rate of interest is 6%, and we have borrowed it for 3 months. So 6 divided by 12, 0.5. 100 plus 100 into 0 point sorry 0.06 into 3 divided by 12, 0.25. So 100 plus 100 into 0.015, you get 1.5. So this is 101.5. So the interest, the total amount, the terminal value which you are going to pay for the money which you borrowed is 101.5. The short forward contract, you will deliver the shares and you will get 105. By getting this 105 from the forward contract, you will pay 101.5. So the balance is the profit which we are making. That is 3.5 is the profit we are gaining out of it. Further, suppose it is after 3 months, the forward price instead of 105, the forward price is 99. This thing will not work out. So what we have to do is we can short sale one share. We can short sale one share at a current price, that is 100, and invest the proceeds of the short sale at 6% per annum for 3 months, and take a long position in 3 months forward contract. The proceeds of the short sale will grow. That is, we will receive 1.1 101.5 after 3 months. The proceeds of the short sale will grow and we will receive this amount. After receiving this amount, we are in a long position that we will get the share for 99 rupees. Now we have made a profit of 2.5. So we can use this formula F equal to S exponent RT. So where F is a forward price, S is a spot price, S this one. Yeah, this is uh, Yeah, actually this is the formula, but this will be confusing for you because we have to use exponent, which is will be available in the scientific calculator. Otherwise you can I can say that 100 into 6 percentage. Okay, 100 into 6 percentage, you'll get 6 rupees. So this 6 into 3 divided by 12, you'll get 1.5. Is it clear? So the amount which you have invested is 100. For that you will get 1.5 percentage interest. So the total amount is 101.5. Okay. So in first case, the forward price is 105 and the spot price is 100. So forward price is more than the spot price. So what we are doing, we are borrowing money from outside and we are creating a short position. Whereas in the other case, we assume that the forward price is 99, but the spot price is 100. Forward price is lesser than the spot price. So what we do, we are going for a long position. We are short selling our share and we are investing it and we are getting a return out of it. That return is 101.5, and after 3 months we are purchasing the share again, which has got the price reduced, that is 99 rupees. So we are making a profit of 2.5. If the forward price is more, we are going for a short position. If forward price is less, we are going for a long position. Is it clear? So actually this is the formula which we are supposed to use, that is for forward price equal to spot price exponent RT. R stands for rate of interest and T stands for time. So next one, investment assets that provides a known income. So we can, yes. See, you have it. Okay, okay. You have invested 100. Okay, the rate of interest given for this 100 is 6 percentage. Okay, so 100 into 6 percentage, what you get per annum? You will get 6 rupees. You will get 6. The return, if you are investing this 100 rupees for a year, you will get 6. Okay, but in this case you are investing it for 3 months. So what you have to do is 6 into 3 by 12. So 3 by 12 divided by 12, you will get 0.25 into 6, 1.5. Okay. This is the interest return which you are going to get if you are going to invest in 100 rupees for 3 months at the rate of 6 percentage rate. Okay, so this is interest. The actual amount, the principal amount is 100 plus 1.5. It is going to be 101.5. Okay. Okay. Hmm. No, actually, this is for an example that we are having three categories. If an investment asset is not providing any income, we will be calculating like this. It is just for an example. If you are going to get any income out of that asset, then we have to minus it. I'll tell you. Okay. And the investment asset which is not providing an income, you can take certain cases shares and bonds which do not provide any dividend. They will not yield any dividend, but when you sell it in the market, you can sell it for a higher price. Okay. You can sell it in a stock exchange, and then you can get the value for that share, but usually they won't provide any dividends. Okay, the second category, forward price for securities that provides a known cash income. We will consider a forward contract on such asset which provide a known cash income. For example, a coupon bearing bond, treasury securities, known dividends. So let us consider one example. Consider a long forward contract to purchase a coupon bond whose current spot price is 900. Okay, spot price is 900, which is going to mature in 5 years. Assume a forward contract matures in 1 year. Forward contract matures in 1 year. So that the forward contract is a contract to purchase a 4-year bond in 1 year. Further, assume that the coupon payment of rupees 40 are expected after 6 months. So a coupon payment of 40 rupees after 6 months and 12 months. And 6 month and 1 year risk free interest rate are 9% and 10% respectively. This is for 6 months, and this is for 1 year. So situation 1, then the forward price is 930. Spot price is 900 and forward price is more than the spot price 930. So in this case, the arbitrator can borrow rupees 900. You can borrow to buy the bonds and short a forward contract, and you can short a forward contract. So the first payment coupon payment as a present value. So what is the present value of the coupon payment? So we have to calculate it like this. In 6 months, it will you'll get a 40 rupees coupon. So the present value of this is 40 minus 40 into 9 by 100 into 6 by 12. 6 months, 9 rate of interest is 9%. So it is going to be 38.24. the present value. This is the present value of the coupon bond. So 900 minus 38.34. So we are going to borrow 860 1.76 is borrowed at the rate of 10 percentage for 1 year. So the amount owing at the end of 1 year, if you are going to borrow this amount, the amount which we are going to owe after 1 year will be 947.93. We will be owing this one. So the second coupon provides 40 towards this amount, and 930 is received for the bond under the terms of forward contract. So the arbitrator can earn this amount, that is 930 plus 40. After 1 year, the coupon will be receiving. So 40. So totally it is 970 minus 947, which he is supposed to pay for the amount borrowed. So the profit which he will be getting is 22.07. This is the case when forward price is more than the spot price. We can do this. This is situation 1. Similarly, we have another situation that is called as situation 2. Yes, Charles, I don't get you. Can you put it in chat box? This 947.93 is the amount which we are borrowing this amount 861.76. We are borrowing this amount in the beginning of the year. After 1 year, at the rate of 10 percentage, we are supposed to pay this amount 947.93 per the total value. Okay, so when you are borrowing and you are paying this, the income which you are going to get is this, and you are going to pay this. When you are paying this, the balance is profit 22.07. Is it clear? I don't get what. Hmm. Hmm. Yes, yes. E- 861.76 into 10 percentage. Yeah, you will get 86 point something. Yeah. So here we are using the formula exponent e. So there will be some slightly changes in the decimal. So here what we say is, if forward price is more than the spot price, then we go for a short position. If forward price is more than the short price, we go for a short position. This is situation 1. Okay. Situation 2. We assume that the forward price is 905. Then in that case, we have to go, we can short the bond and out into for a long forward contract. The arbitrator will earn 905 plus 40. Sorry, if it is 905, the earnings which we will be getting, if he is going to give it, uh, invest 900 rupees, he will be getting 952.39 after 1 year. Then the return which he is supposed to pay, 905 plus 40, 945. So he will be earning 7.39 as profit. So from the above, it is clear that such asset which provide a known income during the life of forward contract, then the forward price will be as follows. F equal to forward price equal to S minus I exponent RT. So I is the known income which we are going to get. So in this case, we can say that I equal to 40 exponent minus 0.09, that is rate of interest, into for 6 months 0.5, plus after 1 year again we will get 140 exponent minus 0.10 into 1 for 1 year. So by applying this we will get 74.43. So F equal to F, this F equal to spot price 900 minus income. We have calculated here the income which you are going to get is 74.43 to the power, the rate of interest is 10 percentage, 0.10 into 1. So we will get it as 912.39. So this is just a calculation. You don't have any mathematical questions like this. This is just for the sake that you should know how it is being calculated. So if forward price is more than spot price, then we go for a short position. Vice versa, if forward price is lesser than the spot price, we go for a long position. Next, forward price where income is shown as a dividend yield. Yeah, known dividend means that when income is expressed as a percentage of the asset life is known. Let us assume that the dividend yield is paid continuously as a constant annual rate at then the forward price for the asset would be F equal to S spot price exponent or minus Q. So this is the constant rate which is given as return for the return in the form of dividend. The rate R minus Q into T. So let us consider a 6 months forward contract on a security where 4% per annum 6 months contract on a security where 4 percentage per annum is given as continuous dividend. The risk free rate of interest is 10 percentage. So R is 10 percentage per annum. And the spot price of the asset is 25. So then we can calculate the forward price like this. F equal to S spot price exponent R minus Q to the into T. So spot price is 25 E R minus Q. R is 10 percentage. So 0.1 10 divided by 100 you will get 0.1 minus the rate per annum the dividend given is 4 percentage. So 0.04 6 months T 6 divided by 12 you will get 0.5. So 0.1 minus 0.04 get 0.06. So 25 to the exponent 0.06 into 0.5. You'll get the answer of 25.75. The forward price will be 25.75. So when there are three categories of calculating the forward price. First one, when there is no income is given. So we'll be using this formula F equal to SE to the power RT. So S stands for spot price exponent to the power RT. Investment assets providing a known income. Income is known to as this much of income is applicable. When it is given there, we'll be using the formula. We'll be using this formula F equal to S minus income exponent RT. If dividend yield rate is given, we'll be using the formula F equal to S exponent to the power R minus Q into T. So Q stands for the known rate of dividend. So these are the three formulas which we use. First one, F, the forward price equal to S exponent RT. Second, F, forward price equal to S minus income to the exponent RT. If known dividend yield rate is given, forward price equal to spot price exponent R minus Q, that is the rate of dividend which is going to be yield, into T. T stands for the time. Next is hedging with forward contract. So the primary motivation for use of forward contracts is risk management. So let us take an example of foreign exchange risk management. So ABC is an international company. ABC is an international company based in India, and it is manufacturing. It is an Indian company and it is manufacturing, and it is also located in India. Hence, it is labor and manufacturing cost are incurred in Indian rupees. So all cost of production is Indian rupee. But a large fraction of its sales is taking place and its customer it is taking place in US, and its customers who are used to pay it in US dollars, so they are going to pay it in US dollars. So there is a 6 months lead time between the placement of customer order and the delivery of product. So ABC's cost of production is 80 percentage, is 80 percentage. So it is making 20 percentage profit, 80 percentage of sales price. Suppose ABC receives an order for rupees 1 lakh. ABC is receiving an order for 1 lakh US dollars. Receives an order for 1 lakh US dollars. That the current US exchange rate, we suppose it is 70. 1 USD equal to 70 rupees. Now it is 70 rupees. So 1 lakh into 70, it is 7 lakhs. It is going to be 7 lakhs. So 80 percentage, it is going to make profit. So 80 percentage of 7 lakhs is 5 lakh 60,000. Sorry, 70 into 1 lakh, you will get 70 lakhs. So 80 percentage is 56 lakhs. So this is the current situation. For example, if rupee value after 6 months, if it is false to 40 rupees, the value of 40 rupees is going to be 40 lakhs. But the cost of production will not change, it is going to be 56 lakhs. At that time, ABC will make a loss of 16 lakhs. ABC will make a loss of 16 lakhs in Indian rupees. Whereas if rupee value goes up to 80, then they will receive 80 lakhs. Then they will be making a profit of 2 lakh 40,000, 24 lakhs. So ABC company doesn't have an expertise in forecasting exchange rate movement. Therefore, they want to avoid exchange risk. This can do this can be done by selling a forward contract. This involves entering a contract today, uh, we can say an investment bank, under which ABC agrees to deliver 1 lakh worth of goods at a fixed rate of US dollars. So this is called as hedging. This is called as hedging. Is it clear? So whether it is going to be a 40 rupees for $1 or 80 rupees for $1, it doesn't matter. After 6 months, they will surely get 70 rupees per dollar. So this is called as hedging. What is going to happen after 6 months, ABC Limited need not bother about it. Next is offsetting the forward contract. Under forward contract, both the counterparties, short and long position holder, are bound to bear the risk until the expiry of the contract unless one defaults. The payoff is only determined on the expiration date. This means the long position holder gains if the future spot price is higher than the delivery price, whereas the short position holder gains when the future spot price is higher than the delivery price. So any party can permanently get out of the forward contract before expiration date by entering into another forward position which is exactly the opposite to the original position. So this process is usually referred to as offsetting of forward contract. So let us take case 1. So Mr. X. So this Mr. X is in a short position and he wishes to offset. Suppose Mr. X uh, is the wholesale dealer of sugar, wishes to get rid of a short forward position of delivering. Mr. X is going to deliver Mr. Y 50 kgs of sugar. 50 kgs of sugar for 20 rupees 25 per kg on a delivery date. Say this is on July 1st. After 3 months, July, August, on October 1st he is going to deliver this for 25 per kg. Before the maturity of this, before first of October, say on August 1st. August 1st, X decides to get rid of his position and he enters into a forward contract with another Mr. W. On first, he enters into a contract, another contract with W, in which he agrees to buy. So here is in short contract, short position, that is going to deliver 50 kgs of sugar to Mr. Y on October 1st. But here what he wants to offset it on August 1st. So he enters into contract with Mr. W, that Mr. W is going to deliver to Mr. X. Now Mr. X has got long position. Here X is having short position. Here X is having long position. The same 50 kg sugar for rupees 24 per kg. and this is for October 1st. So both contract expires on October 1st. So by doing this, yes, offset the contract. So since Mr. X initial position was to sell from Mr. W rupees 50 kgs of sugar at rupees 24, and then the contract expires on 1st of October. So this is called as offsetting position. The same thing we can take in case of case 2. Mr. Y. Okay, we see here is Mr. Y. This person is in long position. Y is in long position in this contract. So what he has to do is he has to go for a short position now to make the contract as offset. So let us say on Mr. Y decides to get out of his position and hence enters into a forward contract with another Mr. V, in which he agrees to sell. That is offsetting position. He agrees to sell to Mr. V 50 kgs of sugar at rupees 26 per kg. So Mr. Y becomes gets the short position here, where he agrees to sell to Mr. V the same 50 kgs of sugar for rupees 26 on October 1st. So in between July to October, this happens on August 1st. So here his long position has offset the contract by making another forward contract in which his position is short position. So yes, offset the contract. The next one is margin. So margin is applicable for future contract. What do you mean by bits? Lakhs and what is bits? Lakhs and you don't have any calculation for your exams. It is just a theory paper. You don't have any calculation. It is not a mathematical paper, and you will not have any questions related to problem. If at all you have a problem, only a simple interest calculation, not more than that. So ma, uh, ma, margin in future trading. So for forward contract there is no margin, but for future contract we have a margin. The initial deposit of good faith made into an account in order to enter into a future contract. This margin is referred to as a good faith because it is this money that is used to debit any day-to-day losses. So contract are marked at the close of each day trading day until the contract expires. At the expiration, there are two different mechanisms for settlement. Most financial futures, such as stock index, foreign exchange, and interest rate futures, are cash settled, whereas most physical futures, agricultural, metal, and energy futures, are settled by delivery of the physical commodity. Margin rules are stated in terms of initial margin, which must be